Hey everyone, and welcome back to the channel. Today, we're re-diving into a topic that many families face but often struggle with: lending money to your kids. It sounds simple, right? But if not handled correctly, it can turn into a source of stress and tension. So, let's talk about how to set up a family bank the right way, creating a structured loan that helps your kids and protects your relationship. First off, why even bother with a formal loan structure? Why not just hand over the cash? Well, think of it this way. A structured loan is a powerful teaching tool. It introduces your kids to the world of finance in a safe, supportive environment. They learn about interest, repayment schedules, and financial responsibility. Plus, it sets clear expectations for everyone involved, which is crucial for preventing misunderstandings down the road. It transforms a simple handout into a lesson in accountability and financial literacy. And for you, the parent, it provides a clear framework for getting your money back, protecting your own financial future. So, you've decided to lend the money. Great. The very first step is to have an open and honest conversation. This isn't a quick chat over dinner. Set aside dedicated time to discuss everything. What is the loan for? A down payment on a house? Starting a business? Buying a car? Be clear about the purpose. Then, talk numbers. How much do they need, and how much can you comfortably lend without jeopardizing your own retirement or emergency funds? This is not the time to be a financial martyr. Be realistic about what you can afford. This initial conversation is the foundation for everything that follows. It's about aligning expectations and making sure everyone is on the same page before a single dollar changes hands. Now, for the nitty-gritty, creating a formal loan agreement. I know, it sounds a bit intense for family, but trust me, this is the most important step. A written agreement is your best friend. It eliminates, I thought you said, conversations later on. You don't necessarily need a lawyer for this, but you can find plenty of promissory note templates online. What should this document include? First, the basics. The names of the lender and the borrower, the total loan amount, and the date the funds are provided. These are the non-negotiables. Next up, the repayment terms. This is where you detail the structure. Will there be monthly payments? Quarterly? What's the exact payment amount? Specify the due date for each payment, like the first of every month. And what's the total loan term? Is it a 5-year loan? 10 years? Be precise. For example, the borrower will repay the loan in 60 monthly installments of $500, due on the first day of each month, beginning August 1st, 2024. Clarity here is key to avoiding confusion. Let's talk about interest. This can be a tricky subject with family. You might be tempted to offer a zero-interest loan, and you can, but you should know about the IRS. For loans over a certain amount, currently $10,000, the IRS might have something to say if you don't charge interest. They have something called the applicable federal rate, or AFR. This is the minimum interest rate the IRS considers acceptable for private loans. Charging at least this rate can help you avoid potential tax complications ways, like the IRS treating the forgiven interest as a taxable gift. You can easily look up the current AFR online. It's usually much lower than commercial bank rates, so it's still a fantastic deal for your child while keeping things official and above board. Your loan agreement should also clearly state the interest rate and how it's calculated. Is it simple interest on the principal, or is it compounded? For most family loans, simple interest is, well, simpler and perfectly fine. Also, decide on how the payments will be applied. Does the payment go towards interest first and then the principal? Or is it a mix? Spelling this out in the agreement prevents any future disagreements about the remaining balance. Now, we need to address the elephant in the room. What happens if a payment is late or missed? This is an uncomfortable but necessary part of the conversation. Life happens. Your child might lose a job or face an unexpected expense. How will you handle it? Your agreement should include a clause about late payments. Will there be a grace period, say 10 or 15 days, before a payment is considered late? Will you charge a late fee? A small fee can be a good incentive to stay on track without being overly punitive. More importantly, discuss what happens in a scenario of default, which is a longer-term failure to pay. Does the entire loan balance become due immediately? Will you discuss a temporary deferment or a modification of the loan terms? Having a plan for the worst-case scenario doesn't mean you expect it to happen. It means you're prepared, and it encourages your child to communicate with you immediately if they're facing financial trouble, rather than hiding it out of fear. Open communication is your most valuable asset here. Once the agreement is drafted, everyone involved should read it carefully, understand it, and sign it. Consider getting it notarized. This adds a layer of formality and seriousness to the agreement. It sends a clear message that this is a real financial commitment, not just a casual family favor. Each party should keep a signed copy for their records. This document is now your official guide for the life of the loan. With the loan active, the next phase is management. How will you track payments? A simple spreadsheet can work wonders. Create columns for the payment date, the amount paid, how much went to interest, how much went to principal, and the remaining loan balance. Update it every single time a payment is made. This creates a transparent record of the loan's progress. Share this tracker with your child regularly, maybe every quarter or every 6 months. This keeps you both accountable and provides a great visual of their progress in paying down the debt, which can be incredibly motivating. Also, establish how payments will be made. Will they hand you a check? An automatic bank transfer is often the best method. It's convenient, reliable, and creates an easy-to-follow digital trail. The set-it-and-forget-it nature of auto payments helps ensure payments are made on time, every time, reducing the need for awkward reminder calls. Let's think about the big picture. This family loan isn't just a financial transaction, it's a relationship dynamic. Throughout the process, maintain your role as a parent, not just a lender. Celebrate their milestones. If the loan was for a house, be excited about their new home. If it was for a business, be their biggest cheerleader. The loan should be a tool that supports them, not a cloud that hangs over your relationship. Keep the loan conversations separate from general family time. Don't bring up a late payment during a holiday dinner. Schedule specific, private times to discuss finances if needed. Finally, think about what happens at the end of the loan. Once that final payment is made, celebrate it. Acknowledge their hard work and responsibility. You can even sign a simple document confirming the loan has been paid in full. This brings formal closure to the agreement. Your child has successfully managed a significant financial obligation, and you've successfully helped them achieve a major life goal without damaging your relationship. That's a huge win for everyone. By structuring a loan to your kids this way with a clear agreement, fair terms, and open communication, you're giving them more than just money. You're giving them a priceless education in financial responsibility and a stepping stone to their future, all while strengthening your family bond. Thanks so much for watching today. If you found this helpful, please give this video a thumbs up and consider subscribing for more content on managing family finances. Let me know in the comments if you've ever loaned money to a family member and how it went. See you in the next one.